Good morning, everyone. Welcome to this update for global stocks and commodities for the 30th of July. Not a lot of change in markets during the week, or in stocks anyway. There was certainly some changes in currency markets, but stock market's still in positive mode. And what I want to do today is just have a look at are markets topping. There's been quite a lot of conversation spike up in the last few days about markets are showing signs of topping out. So that's starting to become a more commonly held view, and that's absolutely fine by me, because whilst the majority of people are not bullish, then the market has every chance of continuing higher. So I want to have a closer look at the American indices. So I'll look at the S&P, the Nasdaq, and the Russell to see if there are any changes of character happening that could tip us off that perhaps we were going to get a more decent correction. I also want to take a look at the gold sector as well to see if there are any signs there of improvement. So let's jump straight into it. American stocks. There was a breakout and a surge in any stock or index or whatever it might be. Is generally followed. So I'm speaking in general terms here. It's generally followed by one of two things: either a topping process, which is demonstrated by a change of character. We start to see candle patterns and volume patterns that we haven't seen for a long period of time. And we start to see prices move down below moving averages that have been providing support. And I've done this exercise periodically over the last 2 or 3 years on the S&P, looking at what the 2000 and 2008 peaks were like when the change of character became evident. And in both cases, it was of the order of 4 to 6 months ahead of the severe part of the decline. So these changes of character are pretty easy to spot. So we get that, we see that change of character, or we don't, and it turns out to be just a pause or consolidation. So that's in general terms what happens. Now with the Nasdaq, there's no sign of weakness, as I'll show you on the chart. No change of character whatsoever. So don't try and second guess a top, because there isn't one. The Russell 2000, I spoke last week about the breakout, and after such a lengthy period of consolidation in a range of about a year, then we could expect the Russell over the next 6 months, perhaps longer, to go into a renewed uptrend. Now, the Russell did pull back a little bit in the latter half of the week, and that's perfectly normal. Retesting the breakout is a perfectly normal action. The key now is what happens from here. Do those support levels hold? So we'll have a look at the Russell as well. The S&P was exactly flat for the week, and on all indications, we're probably entering another small consolidation period at this stage. And finally, the VIX. A lot of people are worried about the VIX, that it's been down for so long and therefore there must be complacency. I get concerned about complacency when everyone is bullish, but that has not been the case since 2009. This has been the most hated bull market in history. There is still a lot of money on the sideline, and there is still a lot of sentiment negativity around this market. So I'm not concerned by the low VIX. Because there's just not the positive sentiment that is more typical of a top in the market. So let's jump in and take a look first of all at the S&P. So not a lot of change there, as you can see. We spiked up a little bit and then gave back a little bit on Thursday and Friday. But you'll notice on Thursday when we did get a dip, so 2480 was a target that a lot of technical analysts who use various techniques for projecting forward levels when there isn't any overhead resistance. A lot of people had that 2480, 2482 mark down. I can't speak to whether those projections have any validity or not. I'm just neutral on it. But it became a bit of a self-fulfilling prophecy, I think, because a lot of people were expecting that there'd be resistance at that level. then in fact we do see a little bit of selling. That selling kind of accelerated, but you'll notice that the index finished well off its lows on the session, and so therefore there was very ready buying support coming in. Friday gap down also, so the distance from the close on Thursday to the open on Friday was another gap down, but as you can see the market steadied and closed near its highs. So I'm not seeing anything untoward in the S&P at all. The daily ranges are still relatively small. The green 20-day moving average, the index is still above that, which is indicating strength in the short term. It's well above the 50-day, which is the blue line, and it's miles above the 200-day moving average. So there is absolutely nothing there to suggest a topping process in the market. Now, will we get a little bit of a pullback, perhaps down to the 2450 mark? Quite possible, quite likely, in fact. Will we just get another high-level consolidation up here around 2465 to 2485? That's also possible. Let the moving averages catch up, because you can see that we rarely breach below the blue 50-day moving average line for more than a couple of days. So that could occur. But let's take a look at the NASDAQ now. So this is looking at the NASDAQ on a weekly chart. So a bigger time frame view here. Right over on the left hand side is 2011. We got a little wobble in August of 2015, and then again in January, February 2016. And at that point, this was a change of character. And so I was certainly on alert as to what was going to happen there. But ultimately, we didn't get a break of this key swing low from August of 2015, and the market has just continued on to form higher highs and higher lows. Now, I've put a couple of trend lines in here. This is a trend line that was established between February and July of 2016. So that trend line projects a rate of increase going out that way, and that's almost perfectly in line with the 200-week moving average. But then you'll notice there's been an acceleration of this trend. So from here, the trend has actually gone up on a steeper trend line, and is still well above it. So what would signal a change of character for the NASDAQ? Well, first of all, you'd need to see a break of this trend line to even, start to be in the least bit concerned. So that would be the first thing. The second thing is you'll notice that there's also a trend channel here, which the price has managed to get outside of. And if it came back into that trend channel, then that would be the second point that would probably just cause, give me a little bit of cause for concern, but it would depend very much on what the candles look like and what the volumes were that were associated with that. But all we can say at this point in time is that the NASDAQ is still leading the way, which is healthy for the market and is showing absolutely no signs of topping whatsoever. Let's turn now to the Russell. So this is the Russell on a daily. We had a substantial run higher in the Russell throughout 2016, and then by February of this year, we started to move in a bit of a sideways pattern, and you can see that we did form some higher lows through here, and also a mildly higher high. We then got another consolidation at a high level here around the 1400 to 1420 mark, and then we finally got a breakout, which is what I talked about last week. So having consolidated for a period of time and now got a breakout, it's highly likely, not guaranteed, but highly likely that we'll see the Russell now kick on for a period of time, which could be many, many months or longer. So the overwhelming odds favour the Russell 2000 small caps going into a renewed uptrend. That's the overwhelming odds. So therefore, all we really need to do is to look at what would signal that this is no longer the case. So we've had a breakout, we've had a retest back to these highs. I'll just zoom in there a little bit further. So again, as with the analysis on the Nasdaq, the first thing I would be looking for would be a break of this steeper trend line. So we've had an initial trend line set, and then the trend has started to accelerate. So I'd want to see that first of all. But this is such a short time frame that even if that trend line does get broken, I wouldn't be concerned about that at all. If we then close below this level, which is the breakout level, then that would cause me a little bit more concern. And if we fell below this inclined trend line, let me just extend that through a little bit further. So if we then fell below this trend line, then I really would be concerned, and I'd probably be taking some defensive action on small caps and on the market as a whole. But at the moment, as with the Nasdaq and with the S&P, there are absolutely no signs of any change of character. So my answer to those that are calling for a top in the market is rubbish. Can't see it. You're just guessing, and this trading in the stock market is not an activity for guessing. Okay, let's look at Aussie stocks. I will go back and look at the US dollar and also at the VIX index as well, but I'll just quickly go through this slide. The Aussie dollar has powered up to over 80 before a small retracement into the end of last week, and that was mostly about the US dollar declining a little further. It's getting very close to some pretty vital support. Also higher commodity prices, of course. The US dollar is contributing to those. And also more positive expectations around China are also fueling commodity prices. So despite all the people that have been saying since about 2013 that China was a basket case and was going to fall over, it never does. And of course, the third element that has really stimulated the Australian dollar is some pretty dumb comments by the RBA, where they talked about a 3.5% neutral interest rate. That was probably one of the least clever things they've ever said, and I think they've been scrambling to claw back from that position ever since. The ASX 200 was lower again, 20 points on the week. And again, we saw a decent sell-off on Friday. That's, I think, 3 of the last 4 Fridays have been pretty negative days. And so we just remain stuck in this very tight range between 5,600 and 5,800. So let's take a look at a few other charts. We'll start with the US dollar. So we continue to move lower, but as you can see, we're getting quite close to really important long-term support. So this support goes all the way back to August of 2015. So that's a pretty critical level that this holds, and I think that it's such an important level that there's almost certainly going to be buying come into the US dollar at that level. If it doesn't, then we have a whole new ball game on our hands. If this US dollar doesn't bounce with some significance from here, I'm not suggesting it's going to go all the way back up to 100, but we need to see a bounce of 2 or 3 or 4 cents on the US dollar. Otherwise, there would be a new trend in place, and that has very widespread ramifications. Let's just look at the VIX index. So a little bit of a tick up. Earlier in the week, we plumbed down to basically new historic lows. That was on Tuesday. It did tick up a little bit, but look, we're still sub 10 on the VXO, which is incredibly low, and it's going to be very interesting to see how this plays out. Turning now to let's look at the Australian dollar. So we had important resistance at about 78. We've popped up above that now. Had a little look over 80. It is overbought up here. Fundamentally, the Australian dollar is regarded as one of the most overbought currencies in the world, according to a Bloomberg index, and also according to the IMF, the International Monetary Fund. So fundamentally, the Australian dollar has no right to be up here where it is. And of course, the other aspect is that in the futures market, the Australian dollar speculative position is now extremely bullish, which is generally getting towards a point where you get a contrarian reversal. So I wouldn't be surprised to see a significant bounce in the US dollar, a decline in the Australian dollar, and things get back onto a more even keel. This is the ASX 200. Doesn't really tell us a great deal other than the fact that this is pretty much what the banks have been doing. So you can see we've been stuck in this range now, this fairly tight range, since about the middle of May. So not a lot changing there. Just while I'll go back to the slides. So precious metals, gold rose by $15 up to $12.70. So that was the third successive weekly gain, and certainly looking a little bit more positive. But we've got to remember that at least a good part of this is due to the US dollar weakness. It's a currency effect. Not all of it, but more than half of it is currency effect. 1300 is still the key resistance target for gold. And I also note that the gold holdings in GLD, the world's global ETF, it fell again, dipped under 800 tons this time. It's back down to 791. So this is also consistent with with a bit of the throwing into the towel by not only the futures players, and they started doing that a number of weeks ago, but also now the ETF market is starting to throw in the towel a little bit as well. So from a contrarian point of view, they're all positive signs, or positive indicators. Looking at precious metal stocks, they are looking a little bit better, but they're still in a declining wedge. And I want to look at GDX to see what we can determine from that, and what things we should look out for on the upside and on the downside. So let's go first of all. I'll just check in on silver. So there's silver, still in a channel, lower highs, lower lows. So there's been no change there. Let's look at gold on a weekly basis. So a big long-term downtrend since the peak in 2011. And we still haven't been able to break through this resistance line as yet. Although, as you can see, we have had 3 fairly handy weeks in succession. Now, let's zero in on the daily. Looking a little bit more positive on the daily. We've certainly got a consolidation above the previous low that we saw at the end of last year. But we do need to break out here above 1295 to 1300 to start to feel that something's changing in the gold market. Let me have a look at GDX, because I guess ultimately it is the stocks that most people are interested in. So what do we need to see? This is GDX. Let me just pan back and give you a bigger picture look. So we had obviously a major decline from 2011. We started to form this base after a big selling climax. You can see there was a big red volume spike. So that was where the real tossing into the towel happened. That was in July of 2015. So a lot of people sort of gave up on precious metals at that point, and that cleared out most of the sellers. So we then got a range set up. So from July 2015 until January of 2016, we had a fairly definite range with a couple of meaningful bounces along the way. And then finally, the sector managed to gain enough momentum, and it absolutely rocketed up. And GDX went from the low $17 and it went to $32. This was the fastest and strongest rise out of a bear market that we've ever seen, going back more than 100 years. In fact, going back nearly 200 years. So an enormously powerful run up. Now, since then, the market topped out in the middle of last year, so about 12 months ago, and we've done an almost perfect 61.8% retracement, and then formed another consolidation pattern that we're still in at the moment. So you can see we've got this fairly neutral looking wedge, and at this point in time, you really can't have a great deal of confidence about which way this might go in the short term or even the medium term. But what is it that we need to see to feel more positive about gold stocks? Well, firstly, what I'd like to see is a run up to resistance here, which is it's currently at about 23. I'd like to see it run up to resistance around 25 with some rising volume. So I'd want to see some of these volume spikes that we're seeing back here. See these taller green markers? I want to see a higher number of those in this run up, indicating that there's a bit of urgency coming into the buying. The second thing I'd ideally want to see, we don't have to see all of these things, but ideally I'd like to see the range of the candles getting bigger, as you can see with this one here. The third thing is, if it did pause at resistance and not go straight through, then I'd want to see any sort of pullback to be quite shallow, maybe just down to about here somewhere. So if it ran up to around 25 and maybe just pulled back to 24 or something like that. And if that pullback occurred on low volume, that would also be good. And then finally, if we are going to get a breakout, that breakout is accompanied by higher volume. So that's what we're looking for on the upside. If we don't see at least 2 or 3 of those things, then there really is no sign that the precious metals market is taking off. On the downside, obviously, I would not want to see a break of this trend line. If we get down below 21, so let's say 2050, that would be a particularly bad sign and would indicate that that we could be going back to the bottom of this trend channel, which is down here around 13. So that wouldn't be good at all. So they're the things to look for on both the upside and on the downside. Other commodities, copper was up strongly to 285. Crude oil, some powerful gains up to 49.70. But again, both of those certainly currency influence. Stocks in the energy sector showing a bit more promise, but still a bit early to be confident about a renewed uptrend. And we'll take a look at the sector ETF for oil. There's the spot copper chart. You can see quite a strong surge over the last week or two. And similarly with oil, we've come up now from just under 43 and we're now back knocking on the door of $50. So to wrap it up, this is a seasonal time to be vigilant. A mild pullback has to be a possibility, so factor it into your game plan, but I certainly wouldn't be taking any drastic action or panicking, because seasonality is, in terms of where the pecking order is, seasonality is only really a minor consideration. People write to me and say, I'm expecting the market to fall over in September, October. And it might, and there's probably a bit of a record that it happens more often than not. But in my view, there's a lot of years when that doesn't occur. And if you place your bets on seasonality alone, then I think you're going to lead yourself down the wrong path totally. My advice is stay with the strength. The strongest sectors may in fact not decline if we do get a bit of a general pullback. Identify the strongest sectors, then within those, the strongest industry groups within those sectors, and then of course then into the strongest stocks within the groups. So that's the way to go about it. Now, I did mention that I just would show you the energy sector. So let's look at XLE, which is the energy sector ETF. So we've clearly been in downtrend since December of 2016, but certainly signs now that we've got a base and we're starting to turn up. what I would like to see to feel a little bit more confident about this is a break above that level there. That would give me a little bit more confidence. So XLE up around 68, I think would be a good sign. And again, particularly if it's accompanied by some stronger volume. So that's what I'm looking for in energy. So that's it for this week. For non-members, if there's any interest in communicating with me, there's my contact details, and I'll be back with you next week. Cheers.